Here's a scenario that plays out more often than most exporters want to admit. A company has 30 active buyers. The top 3 account for 60% of outstanding receivables. All 3 are in the same country. 2 of them are in the same sector. Individually, each buyer looked fine. Good payment history, reasonable credit scores, no red flags. Then a currency crisis hits that country. Import licensing tightens. Within 1 quarter, 2 of those 3 buyers go into payment default. The exporter loses a third of their AR book in 90 days. Not because any one buyer was a bad credit decision, but because no one was watching the portfolio. That is what this episode is about. In episode 15, we talked about country and transfer risk, the political and sovereign level forces that can stop payments even when your buyer is willing and able to pay. Country risk does not affect buyers in isolation. It affects every buyer you have in that country simultaneously. So if you have 5 buyers in Turkey and Turkey introduces foreign exchange controls, you do not have one country risk problem. You have 5 buyer problems, all triggered at once. That is the portfolio dimension of country risk. And it is why managing trade credit buyer by buyer and without a portfolio view leaves exporters exposed in ways they often do not see until it is too late. Let us break down the 3 dimensions of portfolio risk that matter most for exporters. First, buyer concentration. What percentage of your total AR is sitting with your top 5 buyers? Your top 10? If a single buyer represents more than 10 to 15% of your receivables, you have meaningful concentration risk. That is not necessarily a reason not to do the business, but it is a reason to structure coverage around it. Second, country exposure. You might have 20 buyers spread across 6 countries, but if 12 of them are in the same country, your geographic diversification is an illusion. Country-level events, sovereign default, currency crisis, sanctions, political instability affect all 12 at once. Third, sector correlation. Buyers in the same sector tend to struggle at the same time. If you export to 5 automotive suppliers and the automotive sector hits a down cycle, their credit quality degrades together. Sector correlation amplifies the effect of buyer concentration. The problem is not any one of these in isolation. It is when they stack. High buyer concentration in a single country, in a correlated sector, that is where exporters get hurt badly and fast. Here's where trade credit insurance does something that most exporters do not fully appreciate. It does not just protect against individual buyer default. It forces a portfolio discipline that most exporters have never had. Let us walk through the 4 main policy mechanics. Name buyer limits. A multi-buyer TCI policy lists your major buyers individually, each with a specific credit limit. The maximum amount the insurer will cover on that buyer at any time. The insurer's underwriting of each named buyer is a second credit opinion you did not have before, and the named buyer limit creates a natural ceiling on your concentration in any single relationship. Discretionary credit limits. For smaller buyers below a certain threshold, most policies give you discretionary authority. You can approve credit up to a set limit without carrier pre-approval as long as the buyer meets your internal criteria. This lets you move fast on smaller orders while keeping underwriter discipline on the large exposures that actually drive concentration risk. Country sublimits. This is the one most exporters do not ask about when they first buy a policy, and should. A country sublimit caps the total insured exposure you can carry in a single country at any given time. It is effectively the policy expressing a geographic concentration limit. Used well, it prevents you from quietly accumulating 60% of your book in one market. Aggregate policy limits. The total policy limit caps your insured exposure across the whole book. This aligns your maximum receivables exposure with your balance sheet capacity. The aggregate limit is the policy level expression of what risk appetite you have actually committed to. Put these 4 mechanics together and you have something most exporters have never built on their own. A structured, carrier-validated framework for managing buyer concentration, country exposure, and aggregate credit risk simultaneously. When exporters make this shift, from per-buyer credit approval to portfolio-level management, a few things tend to happen. Credit decisions get faster. When you have a policy structure that pre-approves limits for named buyers and sets discretionary authority thresholds, your sales team is not waiting days for a credit decision on a repeat buyer. The framework does most of the work. Bad debt write-offs drop. Not because every buyer is now risk-free, but because you have eliminated the situations where concentration risk created outsized exposure on a single event. Growth into new markets becomes deliberate rather than accidental. With country sublimits as a tool, you can decide consciously to grow your Vietnam exposure to 20% of your book and structure coverage to support that, rather than discovering you are at 30% after the fact. And here's the less obvious one. The insurer's aggregate level discipline transfers to your own credit management culture. Your credit team starts thinking in terms of portfolio exposure, not just individual buyer quality. That is a durable shift in how credit risk is managed, independent of whether you ever file a claim. If you're reviewing or structuring a multi-buyer TCI policy with portfolio management in mind, here are the questions that matter. What is the discretionary credit limit, and is it sized for how you actually operate? If your average transaction is $200,000 and your discretionary limit is $50,000, you are going to be in the approval queue constantly. The limit should reflect your deal flow, not just your insurer's default setting. How deep is the name buyer limit coverage for your top 10 exposures? The buyers where you have the most to lose should have the highest quality name buyer underwriting. Do not accept thin limits on your largest relationships. Does the policy include country sublimits, and do they reflect your actual geographic distribution? If you do significant business in 5 countries, each one should have an explicit sublimit that aligns with your strategy, not a blanket coverage that obscures concentration. How does the aggregate limit align with your typical AR balance? A policy that covers 50% of your peak AR exposure is not portfolio protection. It is partial coverage with large gaps. Know the ratio. These questions will not always have easy answers. Some carriers will push back on sublimits or set them conservatively. But asking them is how you get from a TCI policy that is an insurance product to a TCI policy that is a credit management framework. Here's the reframe worth carrying out of this episode. The question is not, should we insure buyer X? The better question is, does the structure of our TCI policy match our actual portfolio risk appetite across buyers, countries, and sectors? Most exporters have never asked that question explicitly. Most of them are carrying more concentration risk than they realize, in geographies they are not fully watching, in sectors that move together when conditions shift. Trade credit insurance, structured well, is the tool that makes that question answerable and actionable. If you are a CFO, treasurer, or credit manager who wants to think through what portfolio level TCI structure looks like for your business, the link to Impello Global is below. And if you have not watched episode 15 on country and transfer risk, that is the natural starting point for this conversation. Subscribe for more. We are back next Tuesday.